Here's what's interesting. I recently was doing some research on IRMAA, and I went back to, I think I looked at a chart that went back to 2000, and the increases in the IRMAA rates and the IRMAA brackets they're just going up and up and up and up and up and up, right? Now
it's over a 7% annual increase in IRMAA rates just since 2019.
And think about how that 7% increase would compound over 30-year retirement, right about the time your tax time bomb's going off. So let's switch gears. Now, you and I could talk for days. In days, right? We would probably bore our listeners after a while, but so let's talk about the tax time bomb. I mean, you know what I'm talking about. I'm looking. I literally have my retirement tax bill calculation right here. All right. Yep. And by the way, folks, we have one. We'll give this away at the end of the podcast here. But retirement tax bill is, you've put money in this IRA, 401k, 403b, TSP. What am I missing, Becky? Anything?
Yeah, TSA, that's about all the alphabet.
Yeah, all the acronyms. You've put money in and have not paid tax on, and then those dollars are grown tax deferred, and now you're ready to retire and spend these dollars down. Well, guess what? There's a old adage in life that the only two guarantees in life are death and taxes. And I really do believe that adage came from RMDs, which is required mandatory distributions that you must take from your IRA account starting at various ages. I think we're up to 72 right now, by the way, is the number. And what that says is the government wants you to take money out of the account, pay tax on it. All right. Now, what's interesting to me is if you look at someone who's got $1 million IRA, and let's just use the 4% rule here, for instance, and they're 60, right? They're taking out $40,000 a year. That IRA, Becky, when they reach 72, and that if they're 60 now, to be 75 and they hit RMD age, right? But let's talk about the size of that IRA. More importantly, the amount of these IRA distributions, these RMDs, the taxation on those, and the other taxation of how that can spike IRMAA. I mean, it's just
it just layers upon itself. And, in a way, it's kind of wild that as a nation, we have this much tax risk built into the default way that we save for retirement. And I sometimes like to say, I'm a small business owner myself, and I bet every listener here owns a small business, has a friend or family member that owns a small business. I liken this tax issue with the IRS to this. Like if I own a small business and Ryan, you own, let's say 20% of my business. I know at the end of the year, I got to pay you out 20% of the profit because you own 20% of the business. Well, next year, if you came to me and said, hey, Becky, this year, instead of 20%, I'd like 30% of your profit. I think most small business owners like myself would say, I'm sorry, kick rocks. You may want 30%, but you own 20%, so I'm only giving you 20% of the profit. That's your piece. But the IRS is like a silent investor in our IRAs and our 401ks. It's a silent partner that can change its ownership stake at any time. And this year, the IRS may be okay with the 20% ownership, and next year they may want 26% ownership. But unlike in our businesses, we can't tell them to go kick rocks. We just have to pay whatever they demand. I don't like that kind of volatility in my business. I would never accept a partner in this company that can change their ownership at any time. I don't want savers to accept that in their retirement approach either. And that's why this ticking tax time bomb is coming for so many savers. It's because we have this risk that at any time a partner in our retirement account can change how much they get, which dramatically can reduce how much we get to keep and spend.
Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.